So, I finally managed to sit my procrastinating ass down to do a re-evaluation of my entire portfolio, at least for the major positions. So for those of you who do follow me, I've released a previous video where I said why I have $120,000 invested in 20 specific names. For those of you with sharp eyes, this is my current portfolio standing, accurate as of 14th of April, and there are 22 positions. So you might want to leave in the comment section down below what's the 2 new additions. If not, I think getting back to the main subject of this video, I'm just going to outline how I look at the intrinsic value of my major positions. And to me, it has to at least sit at above 2.5% in terms of allocation. And just by looking at that benchmark, there are a total of 9 names here. Alibaba, Tencent, Chinese banks, Amazon, TSMC, Meta, Google, Haidilao, and LVMH. And it's also pretty timely to do this video because most of these companies have already reported their 2023 financial position. And TSMC is going to lead the pack coming Thursday before the market open to talk about their Q1 of 2024. So now, here's essentially the quick breakdown of the intrinsic value that I have for these 9 specific names. So here's how you read the table. The currency essentially explains the dollar value of the IV of the specific company depending on where it's listed. So the company and the ticker, quite self-explanatory. For the 2024 intrinsic value, I have a base case, which is the conservative amount, and the optimistic case, which is in this yellow column. The current price and the upside or lack thereof. And specifically for the upside or lack thereof, it will be divided based on the conservative case rather than the optimistic case. So I'm just going to pull out Alibaba's historical income statement from Seeking Alpha. For those of you who are interested, they are currently running a promo. I believe you can get a 20% discount on a first year subscription and also a 7-day free trial. Not sponsored by them, but I'll leave the link in the description below. So specifically for Baba, I believe most of you already know my underlying thesis. I'll link to 2 specific videos, especially for newcomers. The first one, it's a simple presentation on Baba and mainly its fundamentals, its standing in most of the industries that they're dominating in. And the second one, it's really what you need to know moving into 2024 and what you can expect, the management team, the business performance, etc. So those 2 videos will serve as a good starting point. So when you look at Baba's income statement, denominated in RMB, pre-2021, Baba was that monstrous company growing crazily, 52%, 45%, 56%, 58%. And 2020 was that fateful year where there was a slew of crackdowns, government regulations, Jack Ma went missing, etc., etc. And in the subsequent 2 years, Baba really floundered at a 20% growth rate, and then it just diminishes to around a 1.83% growth rate. So a similar story can be told when you look at their gross profits, from a healthy double digit to a single percentage gross profit. So there are many investors now very skeptical about the growth and the prospects of Alibaba, from competitive pressures to regulatory requirements to them being able to benefit shareholders, etc., etc. So when we look at Baba's model, I think it's fairly intuitive. There's not much expectations or growth being priced into the stock price today, and I'll show you why. I think traditionally, most investors like to use a DCF model. Essentially, what you're trying to do is to project forward the future cash flows or future expected cash flows that the business will generate, and then discount it to the present value of all the future cash flows to get at some sort of an intrinsic value. So for most simplified models, you probably only need 3 specific inputs. The growth rate or the expected growth rate of the future cash flow, the terminal multiple that you're going to exit the business, and the discounted rate, or in this case, a weighted average cost of capital. I'm not going to go through the technicalities, so I think across all models, when I look at the 8 companies or 9 companies, I'm just going to use a standard 10% discount rate. You may argue that it's too high or too low, but I think it's a good gauge or a good benchmark to start off with. So I think when you look at the free cash flow profile of Alibaba, I think it tells a similar story. Everything is fine and dandy until 2021. Do note here, it's until March of 2021, which means that the financial year comprises of 9 months in 2020 and 1 month in 2021. And right after that, you have most of the regulations stepping in. The Chinese economy was not doing well, competition is heating up, etc. And you can see that the free cash flow essentially plummeted by probably more than 50%. Specifically for our simplified model, I'm just going to project out the 5-year projection for their cash from operations and their capex. and then apply a terminal free cash flow multiple and use a 10% discounting. So for 2024, because like I said, Alibaba is a peculiar financial year, this is until March of 2024. And I do believe that this drop in cash from operations and drop in capex is fairly accurate because we already have 9 months worth of data. So 2024 is not important. Now moving on to 2025, here's my story for Baba. I think we have recently seen some major developments around the company. Jack Ma stepping up to talk about how they need to course correct. Zhou Cai also coming out to admit their mistakes and saying that they're going to focus more efforts into R&D, divest many of their useless businesses, and focus back to the core of Alibaba's business. And I think in one of my previous video, I did alluded to the fact that we are probably going to expect higher R&D costs, higher capex, trying to build out their infrastructure, trying to build out their logistics arm, etc., etc. But I am expecting capex to continue stepping up again in the new year, out into March of 2025, which is why I applied a huge, monstrous growth in capex to essentially meet back up to what they have spent in 2021. And thereafter, I'm also not very hopeful for their cash from operations to resume back to normalcy. And thereafter, I think 2026 all the way to 2028, I am just expecting a 15% increase, 7%, 7%. For capex, I'm just going to presume that they're going to hold that high level and continue growing it at 20%, 15%, 15% out into 2028. And for the terminal free cash flow multiple, I do understand that Baba is currently trading at the price to free cash flow of around probably 8 to 10 times. I don't think that's quote-unquote a normal multiple to tag to a business like Baba, but I want to err on the side of conservatism, so I do believe that the terminal free cash flow multiple would be between 12 to 15 times. So similarly for my discounting, I'm going to use 10% across the board, and I get a price target of $147 per share on the base case. And this is me being really, really conservative already because I'm expecting them to continue experiencing a negative cash flow from operations and not a very high growth rate that flows to the bottom line. Because the expectations on the street right now, if I go into Seeking Alpha, looking into the earnings and earnings estimate, looking at top line revenue growth rate, they are at least expected to grow between 5 to 7% out into the 3 years until March 2026. So I guess this is just my baseline projection right now. If I had to bump up to 15 times, which is the more optimistic case, we are looking at a price target of 175. Of course, this is really me being very conservative. I do think that Baba is able to hit a $200 price target, and that's also contingent on a lot of factors, like will they be able to course correct, will they be able to fight out their competition, will they be able to retain customers and continue growing healthily from here on. Because I do believe that the entire ecosystem of Alibaba, whether is it from Alipay to Cainiao to Taobao to Tmall, so all these act as some sort of a toll booth on the entire Chinese consumption pie. I don't think the Chinese consumption story is dead. We are probably in a transition phase. So Weibo is back with more gifts in the month of April. Don't worry, this is not April Fools. For new users, Weibo is currently running a welcome pack campaign where you can get up to $3,000 worth of Nvidia shares. So for a start, if you sign up for an account with the link below, make an initial funding of $500 and complete one buy trade, you can get 5 fractional Nvidia shares worth between $10 to $500 each, 1 month of commission-free US stock trading, and 3 years of commission-free Singapore stock trading. So if you want to qualify for the next tier, the premium pack, you can get another 15 Nvidia shares either by depositing at least $2,000 and complete 5 buy trades, or by subscribing at least $2,000 to Moneybull, which is essentially a wealth management tool offered by Weibo and maintained until the 31st of May 2024. So for the ultimate tier, you can get another $2,950 Nvidia shares if you complete either requirements. You either top up $100,000 into your account and complete 10 US buy trades, or subscribe at least $100,000 worth of Moneybull and maintain until the 31st of July 2024. So premium and ultimate pack rewards are not stackable. This can't get any better. And for those of you who have not signed up for a Weibo account, link is in the description. So moving on to Tencent, I think it spells a similar story because they're operating in the same operating environment The Chinese economy is not doing particularly well. The tech crackdown was pretty broad-based. So when we look at pre-2020, they were growing at a very healthy clip, at least all above 20% year-on-year growth rate on top-line revenue. But moving into 2021, you see that it's up 16% and then 0.38% and then 9.8%. You can see most of them have bottomed out in 2022. And now we are seeing or experiencing the early signs of recovery for Tencent. And I think similarly, for many of these tech companies, you can see that there is also some sort of a decreasing gross profit margin. But I think Tencent is in a much better place compared to Baba. The investment thesis of Tencent is fairly simple. It is the biggest gaming company of the world. Their core business is just one app, which is WeChat. So WeChat is the super app that enables the entire Chinese economy to function. You probably can't survive as a Chinese citizen without WeChat. They have probably already matured in terms of their penetration, but in order for them to continue accruing shareholder value, WeChat as an engine allows Tencent to front run some of these social trends. It allows Tencent to invest effectively. It allows Tencent to have the insight to know where to allocate capital effectively. So they have an extremely viable and strong business, but the valuations of Tencent today is probably punished because investors don't like anything related to China. So I think specifically for my base case projection, when we look at their earnings expectations on the street, they are probably estimating their revenue growth to be between 8 to 12% for the 4 years moving forward. I'm just doing a very, very base and conservative estimate that they're going to grow their cash from operations in line and just take a discount from there. And on the capex front, I'm also going to reflect realities where a lot of all these tech companies are now going to invest very heavily into their tech infrastructure and to integrate many of these innovations into their product suite itself. So I'm not expecting a slow increase for both Baba and Tencent. They're going to pump much more money in terms of their capital expenditure cycle. So that's why I bumped it up from a negative trend straight up to 35% and then just grow it out from there. So a terminal multiple that I apply on Tencent is between 15 to 18 times right here. So I think despite all the fear mongering, Tencent's valuation still managed to hold up much better compared to Baba because it's not in such a precarious position. Even though competition is tough, TikTok, ByteDance, Xiaohongshu, a lot of all these other app economies are trying to compete away Tencent's moat, but Tencent is still very strong. Many investors are probably much more comfortable holding Tencent over Baba. That's why Tencent right now probably have a free cash flow multiple of around 10 to 12 times. But in the future, I do expect them to normalize to 15 to 18 times. Using a discounting of 10%, I have a price target of around 516 on the low, and if I move it up to 18 times, it's around $600 per share. So for the IV, these are my intrinsic value of Tencent. Oh, and for those of you who want more details regarding the fundamentals and the business model of Tencent, I'll leave the link in the description below. I've made a simple presentation on Tencent some time back, but this is not the key focus of this video. Now, moving on to the third largest position, which is Chinese banks. I am receiving some questions from viewers in the comments asking me, what Chinese banks do you hold? Why do you not want to disclose? Why are you dancing around the question, etc.? I think I've made my position quite clear in some of the other videos. I do acknowledge the fact that this Chinese bank exposure in my portfolio is a rather speculative one. I am buying into fear, and there's a lot of uncertainty right now. Many people, even Wall Street people, bankers, they don't know what is on the books. And a lot of people are saying that the Chinese banks are cooking their numbers. So likewise to me, I'm just buying into fear. I monitor many of their financial metrics like PE, PB, dividend yield, ROE, their NPL, their CET ratio. All that said, I think a lot of things looks great on paper, but many investors are probably very, very skeptical of their numbers, which is why they're trading at a price to book of like 0.3 to 0.5 times. Which is unheard of when you compare to other counterparts. But that said, a rule of thumb for me, I do keep my exposure to under 5%, and any of the dividends that I receive from these Chinese banks, I'm not going to reinvest back into these names again. I'm just going to use the capital and just treat it as some sort of a junk bond and just allocate accordingly. So specifically for Chinese banks, some of you also asked me why not just buy a bank ETF that tracks some of these major banks. I think if you really want to take a guess, when you just Google some of these Chinese banks, most of my positions are those that you can find in the ETF itself. So why do I not want to buy an ETF? Number one, expense ratio. I don't want to pay people if I can pick my companies myself. Number two, As we all know, as this real estate thing is collapsing, at least for the last 4 years already, try to avoid those that has huge property exposure. And I want those big ones, much more stable ones, when I understand and study their shareholding structure and try to look into their books. That's how I kind of navigate my way through this very uncertain times. I'm also definitely not encouraging you to go and buy into Chinese banks because, like I said, it's very, very speculative. So that's why I try to hold back a lot of information and let you guys work your way through. Because if it fails, I didn't even tell you what stock I have exposure to, so you probably don't know and you can't blame me. So I hope you guys understand why I'm very reluctant of sharing this side of the portfolio, even though I like to talk about transparency and stuff like that. Now, moving on to the fourth biggest position, which is Amazon. I think Amazon, part of the Mac 7, it's a big tech company. Most of you probably already know the company. I'm not going to explain too much. It's just an e-commerce play. It has 220 million Prime subscription. It has one of the richest company with a lot of data. I do understand or know of friends, and even when I ask people living in the US, they trust the ranking system a lot. I think AI is a very important part of this puzzle, specifically for Amazon's future, robotics as well, and also, last but not least, we can't forget their AWS and their advertising segment. So everything seems to be playing out very nicely for Amazon. I've been accumulating when Amazon was in that down cycle, in their heavy capex era. A lot of people were saying that, Amazon is a lost cause. They're just building and building with no sheer regard for shareholders. But I think if you look at it on a much longer term horizon, Amazon has been one of the best performing companies in the entire stock market. And they have a very clear philosophy and clear mission objective of what they want to achieve. I think there's this very interesting term that was floated around talking about your margin is my opportunity. And whenever Amazon goes into one particular industry, most of these companies are going to be disrupted from the ground up. And that's why Amazon is a disruptor platform. So I think this is just generally the gist of why somebody will be interested in Amazon. So when we look at it from a DCF perspective, some people don't like to use a discounted cash flow method because they say that the free cash flow of the company is very distorted due to the high capex expenditure. Some like to use this metric called the price to operating cash flow. But that's it. I think let's just do a very simple projection. I just want to keep it simple. So you can see that when I was describing the previous quote-unquote glory of Amazon in 2021 and 2022, they were experiencing a negative free cash flow profile of negative 14 and negative $17 billion. Even though it had a $1 trillion market cap, give or take back then. Looking at the early signs of recovery, I'm expecting Amazon to deliver around 60 billion, at least 50 to 60 billion of free cash flow in 2024. And just projecting outwards from here, Amazon is just going to grow in line, probably a little bit lesser than their revenue growth rate, 15, 12, 10, and 8. I basically just taper them off. And specifically for capital expenditure, you can see that they usually come in cycles. So in 2020, 2021, you can see they increased by a very, very large extent, 138%, 52%. That was because they're trying to build out a lot of warehouses to meet basically the pandemic demands. But I do believe that they have overbuilt and they have built enough capacity that's going to last them for the next 3 to 5 years. So I'm not expecting the entire capex to balloon again, not barring any existential or any unforeseen circumstances. I'm just growing it out at 10%. Using a 10% discounting, I get a price target of around 193. That's on the low side of the free cash flow multiple. If I bump it up to the higher side, which is 25 times, it's around 235. So if you can see, I just extract from macro trends. So this huge spike and then going to zero in terms of a free cash flow multiple is back when Amazon was just building and building with no regard of their free cash flow profile. That's why it was zero. But if you look at it in a grander scheme of things, the y-axis is quite distorted. But I do think that on a longer term basis, as they mature much more, they can't command such a high price to free cash flow multiple, which is why I think that 20 to 25 times is pretty healthy, or at least pretty reasonable. Some of you might be more aggressive. You want to bump it up to 30 times, which is more in line with the average figures. I think up to you. I just want to be much more conservative. Now, moving on to the fifth contender, which is Taiwan Semiconductor. So I think in order to get their valuations right, you kind of need to know their story. So TSMC, in my humble opinion, it's one of the most important company in the world today. Regardless of how people keep talking about there's Taiwan risk and whatnot, regardless whether there's a China risk or a Taiwan risk, it's still the most important company. And if in any scenario, TSMC is going to go under because of war, because of fighting, the entire world is going to go under. So that's how important they are. But anyhow, being in the semiconductor industry, it's a pretty cyclical industry. When you judge some of these companies' share price, whether it's TSM, Micron, Nvidia, AMD, a lot of them work in, or they operate in tandem with the semicon cycle. So you can know how important this company is by judging their customers downstream. So companies like Apple, Tesla, Nvidia, they rely 100% for TSM to print their chips. So I think rather than focusing on a lot of these things that we can't control, I think a key focus is really how TSM as a business and the strategy that they employed when compared to some of their important competitors like Samsung and Intel. Both of them decided to go the hybrid model, while TSM focused on manufacturing, focuses on building relationships, focusing on leveraging their capabilities and technology. So I think just these 3 points alone, when looking at the history of how the management team of TSM has conducted themselves, prioritizing their customers, knowing where to allocate their capital, it makes them an extremely high quality company, and I don't see why they're going to veer away from what has been working. But the only disadvantage that I don't really like about TSM is really the capex cycle and their constant need for improvement. In order for them to maintain their lead over Intel, over Samsung, they need to continuously reinvest, and their capital expenditure also moves in cycles alongside the semicon cycle. That, I think, is a little bit hard to kind of guesstimate, but we still have to get a particular figure and be roughly right rather than precisely wrong. So I think at least for the next 2 years, we are just playing right into the AI play. A lot of people are basically queuing up for Nvidia's chips, for AMG chips, and all of them rely on TSM to basically operate and to print out the chips. And there's a lot of backlog, and you see several instances of how supply is not catching up with demand. So specifically for capex and how much they're going to spend this year, TSM did provide some sort of guidance. So 32 billion is the higher end of the guidance. So I'm just going to grow it at 32 billion. And like I said, as we just came out of the semicon down cycle, I do expect the next 2 years, or at least 2024 and 2025, to be good for many of these chip making companies. For 2026 and 2027, I'm not too sure. That's why I'm basically slowing down everything, and they're going to basically pump back money again to prepare for the next cycle. So that's basically my assumptions for Taiwan Semiconductor. And I'm just going to put a full disclaimer here. I think other than the guidance provided by the company, I'm going to expect most of my figures to be wrong here. But like I said, we just need something to work with. I'm applying a free cash flow multiple of between 15 to 20 times because historically, they have been around 20 times. I just want to be more conservative in this case. Using a 10% discounting, the price target is around 136 on 15 times multiple and 172 for 20 times multiple. And that's basically how I get to these two figures. And right now, I would say that TSM at 142 per share is probably right around fairly valued. So I think Meta specifically, when you look at their results, on a year-on-year growth rate basis, it kind of took a very big hit in 2022. A lot of people were casting aspersions on Mark Zuckerberg's ability to manage the team and the company. And people were saying that, oh, he's spending too much money in his metaverse dream. He's forgetting about his core purpose, which is the family of apps, and his skill set in trying to extract value from advertising. That's it. I think it has recovered very strongly. It has 5x from its bottom. And for those of you who did not subscribe to my Substack, I think you guys are missing out on a lot. So I've previously written a Meta platform stock analysis back in June of 2022. And as you can see, it was a pretty long piece. And back then, it was trading around $162 per share. I think really just based on how I analyzed the economic mode and the positioning of Meta platform, they really had something that is very special, that is unable to be competed away by many of these competitors like TikTok and whatnot. Meta is the only real social media platform. So as a creator myself, I've done my fair share of analysis on the different media platforms available for creators. I can observe that Meta has a structural advantage that keeps them relevant: kinship. If I were to categorize the few largest social media platforms out there will be two broad categories: user versus creator focus. Meta comes under the user focus category, where they place a great deal of emphasis on creating the user's personal network, i.e. their friends, families, relatives, etc. On the other hand, all other networks out there, regardless whether it's TikTok, YouTube, Twitter, Pinterest, Reddit, they tend to act more like entertainment platforms where users follow creators. So for those of you who are interested in this kind of analysis, remember to join via the Substack link below. So I'm in the midst of researching another company. I'm probably going to post it by the mid of this year. So you can see it's quite rare to come by. The last article was June of 2022, and the next one might be June of 2024. So maybe you'll get one article for every 2 years. Now, I'm just joking. But anyway, I think just looking at Meta's historical performance, and you can see that 2022 was a recipe for disaster. They took a hit in terms of cash from operations, down 12.5%, and they bump up their capital expenditure, which is why their free cash flow basically just evaporated. I think it went down by more than 50%. Their capex expenditure guidance is around 37 billion, so that's why I bump it up 35%. I do think that their growth rates moving out in the next 5 years, if I can look at analyst estimates, their consensus revenue growth rate is around 12 to 18% for the next 3 years. So I'm not going to expect this kind of huge growth rates to flow down to the bottom line. So I took a haircut to most of these numbers, and I'm applying a free cash flow multiple of around 20 times. So my expected intrinsic value calculation for Meta is around 20 to 25 times, because as you can see, back then when they were hit by a lot of the bad news, by normal times, I think it should be around 20 to 25 times. And using a 10% discounting, I get a price target around 494. And at 25 times, it's around $600 per share. So that's how I arrived to the intrinsic value calculation for Meta platforms in 2024. Similarly, I do think that they are trading right around fair value today. I wouldn't be running out there to accumulate as many shares as I can, unless there's a huge discount that's going to come. Now, moving on to the next company, which is Alphabet. For Google specifically, I think Google is in a pretty interesting spot. So for both Google and Meta, you can see that they're best friends. You can see that they're arch enemies. One is the king of advertising, one is the queen of advertising. But the mode of monetization is slightly different. Meta uses social media, Google uses search. So in terms of this search business, you can see that there is a huge significant slowdown in growth rates as well. That's why back in 2022, there were a lot of recessionary scares, and many of these advertising companies that are tend to be quite cyclical. They tend to follow the economy's boom and bust cycle, which is why there was this haircut in valuation. And just most recently, just 2 months back, because of GPT and a lot of this Microsoft wanting to make Google dance, there were a lot of skepticism around Google's ability to fend off competition. Long story short, I think Google is still one of the most profitable, one of the best in class. And let's not forget, they also have GCP, which is the cloud platform. So moving into the numbers, I think cash flow from operations, they are growing healthily, albeit slowing down. For their capex, they are probably also going to increase their capex cycle, because I understand that many of these tech companies are going to bump up their buying of NVIDIA's chips, training their own large language models, trying to fend off competition. So I am expecting a huge bump up in their capex for 2024, moving on into 2025. Looking in terms of their free cash flow multiple, they have been trading around 25 to 30 times. So just going to be conservative. My terminal multiple, I'm just going to use 20 to 24 times. Using a 10% discounting, I get a target price around 156 on the low and 183 on the high. And that's how I basically arrived to Google's intrinsic value. So similarly, I think for Amazon, TSM, Meta, and Alphabet, they are all right around fair value, give or take. But you can look at it from a range perspective, because I'm comparing them against their base case scenario. I do believe many of these are high quality compounders. So buying them at intrinsic value, not necessitating a margin of safety, might also be a good choice, because we all want to participate in this kind of strong growth ahead. Now, moving on to Haidilao. I didn't use a DCF model, because if you look at the trajectory or the history of Haidilao's free cash flow, it's very lumpy. And right now in China, at least over the last 2 years, the numbers are up and down, up and down. And they swung to the negative and then they swing back to the positive. And I can't necessarily ascertain what is the free cash flow margin that we can kind of expect. So I just use a very simple PEG ratio, which is 1.5x. So at a 1.5x PEG, it's around $16.20 per share. I think using a 2 times PEG, it's closer to $21.60 per share. So it's currently at $17.34. And if you would like to know more about the core business of Haidilao, I'm going to share a link in the description below where I guest posted regarding this company. And I think long story short, this is just the 2 key areas that you need to know of. Firstly, it's this idea of a golden triangle in the F&B industry. It's called location, replicability, and distribution. So intuitively, these are why the factors that make sense. So with the best food in the world, but accessibility or poor customer flow, it will fail. Hence location. With the best location, but every meal tastes different, worse still, each outlet is reliant on one chef. When the chef leaves, the outlet leaves together with him or her. It will fail. Hence, replicability. So with good location and good food, but has a hard time to scale, especially for very niche areas of F&B like your omakase and many of these high-end restaurants, it will fail. Hence, distribution. The biggest asset of Haidilao, it's not its brand, not even its employees, but their entire set of culture and system that was built since day one. They are winning not because their ingredients are the freshest or their waitresses are the prettiest, but because they are damn bloody good at replicating talents from within. If you're interested to read of the entire article, I'll leave the link in the description below. But I think right now, similarly, Haidilao is also right around fair value territory. Now, I think the last company on this list, it's LVMH. So LVMH as a brand, it's a luxury ETF to me. But I can understand on a very philosophical and a very fundamental basis that why luxury and brand equity is here to stay, why people are going to continuously patronize them. It's true, they kind of model after the ebbs and flows of the economy. If economies are not doing well, specifically like the Chinese economy or the Chinese people, they tend to spend lesser. But I think in a long-term trajectory basis, if you look at it as a luxury ETF, you are buying into an umbrella of brands that really are able to command a huge premium. I think LVMH is one of the few, alongside Hermes. Now, I think if you were to look at their free cash flow profile, it's a very simple way to read it. They tend to grow very steadily. In 2021, you can see that there's a huge explosion, probably because of all the stimulus check, and lockdowns are lifted and people can go out to spend, and yeah, that's when they catch up on life. So that's basically what happened to LV back from 2020 to 2021, this transition phase. Now, projecting outwards, I think their cash flow from operations will just continue to chug along. The expectations for LV moving forward, actually, there's not much growth that is being priced into it. And the revenue estimates for the next 3 years, it's probably closer to 5 to 8%. So this is not going to be a high growth business, but it's probably one that is more predictable. Customers know that if I don't buy this back this year, next year, the price is going to increase. Investors also know that they are able to steadily increase their prices over time. I think the only worrisome thing about some of these luxury companies is really the idea of a recession and a huge change in consumption patterns. But looking from that lens, consumption patterns take some time to change, and some of these luxury companies have already managed to deeply rooted themselves into the minds of the consumers. But from an investor perspective, it's probably better to accumulate companies like these in recessionary times when the stock market attach a much lower valuation multiple and when some of their sales and volumes and profit margins start to shrink. But long story short, when you look at their past 10-year record, they've been trading between a multiple of 25 to 30 times. But in my own model, I try to model out 23 to 28 times to be more conservative. And using a 10% discounting at a 23 times multiple, you get around 156 price target, and at a 28 times multiple, it's around 185. So that's basically how I arrived to the intrinsic value of LVMH. So at 165 today, I won't say it's expensive, I won't say it's cheap. It's a high quality company, that I agree. For those of you who are very excited of participating in LVMH's growth, sure, I think it's a good time to accumulate, but grander scheme of things, I think there are much better times to accumulate. But that said, I really don't know when the economy is going to slip into a recession. And in a recessionary times, would all these upper middle class people continue consuming LVMH products? A lot of these things we don't know, so I just invest accordingly. And with that said, I hope you guys enjoyed this discussion, and we'll see you guys in the next video.